All right, Zoe, thank you so much. People in the Bay Area viewing the damage in Los Angeles may be feeling grateful that the fires are not affecting this area, but that may not be entirely true. As John Ramos reports, changes to the way the insurance industry is regulated may mean that we all will be paying for at least part of the cost of rebuilding.
People living in fire-prone areas will soon be paying higher insurance rates if they're not already. But now, thanks to the state's new insurance rules, we all may be paying more for insurance because of the LA fires. One look at the devastation in Pacific Palisades, and it's pretty clear we're entering a new world when it comes to fire insurance. Karl Susman is an industry expert whose home and office are both in one of the evacuation zones.
This level of devastation is just, we're not meant to deal with it as humans, to be able to have a city wiped out in a day. It's almost biblical,
Many of the homes in the LA canyons had already been pushed out of private insurance and into the state's FAIR plan, the insurer of last resort. The dark spots on this map show areas where FAIR plan enrollment has increased by at least 250% in 1 year. Governor Newsom is well aware of it.
My dad's house is under the FAIR plan, the state's plan.
And it's very expensive.
Very expensive, and it's not great coverage.
The problem is the FAIR plan was never meant to have so many customers. Its losses are paid by the insurance companies on a proportional basis, but the plan only has a couple $100 million in reserve and a limited amount of so-called reinsurance, which is an insurance policy to help pay out insurance policies. After that's gone, the new state rules that went into effect last month say the insurance companies will only have to pay the first $1 billion out of pocket before they can start adding surcharges to the bills of any and all of their customers in the state. Steve Young, representing the independent insurance agents and brokers of California, was trying to put a brave face on it today.
It's going to be bad, but we don't know how bad it's going to be. So it's not clear that any assessments will necessarily have to be issued, because again,
you honestly don't think it's going to be more than $1 billion worth of payouts there?
Of assessments, no, because look, the FAIR plan has reserves on hand.
The reality of it is that they're going to have to go to their second and third tiers to get money. They're not going to be in a position to have the money on hand to pay that.
A group called Consumer Watchdog has been critical of the new regulations. They said from the beginning it was an attempt by companies to get all ratepayers to foot the bill for disaster losses.
If people are on the FAIR plan, it's because the private insurance industry put them there by non-renewing or canceling policies. If this catastrophe is as bad as it seems it may be, and if many of those losses fall to the FAIR plan, that could be a bill of $1,000 for every homeowner in the state or more.
But Susman thinks the new rules were necessary.
If it weren't for those regulations happening before this loss, I think what we'd be seeing is a mass exodus of every carrier from the state, because they would have no way of figuring out how to move forward from there.
Moving forward will invariably mean raising rates. The new rules allow insurers to charge more in fire-prone areas. The question is, do we even know where those are anymore?